China has executed the most consequential financial maneuver in modern history by selling $688 billion worth of US Treasury bonds at massive losses during early 2026. This unprecedented liquidation represents far more than portfolio adjustment or profit-taking behavior. This constitutes strategic financial decoupling that signals the end of the Bretton Woods system and dollar hegemony that has dominated global finance for over 7 decades. The decision to absorb substantial losses rather than maintain treasury holdings reveals geopolitical calculations that prioritize long-term strategic autonomy over short-term financial optimization. Understanding the magnitude of China's treasury liquidation requires examining both the scale and timing of these transactions. $688 billion represents approximately 30% of China's total U.S. Treasury holdings and constitutes the largest sovereign bond liquidation in recorded financial history. The transactions occurred during a compressed time frame that maximized market impact while demonstrating China's willingness to disrupt global financial stability to achieve strategic objectives. The loss-making nature of these sales deserves particular attention because sovereign wealth managers typically avoid realizing losses unless compelling strategic reasons override financial considerations. China purchased many of these treasury bonds when yields were substantially lower than current market rates. Selling bonds purchased at higher prices when current market yields have increased creates automatic capital losses that rational financial management would normally avoid. However, China's decision reflects recognition that holding U.S. Treasury bonds creates strategic vulnerabilities that outweigh financial considerations. The weaponization of the dollar-based financial system through sanctions against Russia demonstrated that treasury holdings can be frozen or confiscated when geopolitical relationships deteriorate. China's leadership concluded that eliminating this vulnerability justifies accepting immediate financial losses to reduce long-term strategic risks. The timing coincides with escalating tensions over Taiwan, trade relationships, and technology transfer restrictions that suggest China expects further deterioration in U.S.-China relationships. Rather than risk potential confiscation of treasury holdings during future conflicts, China chose controlled liquidation while markets remained accessible. This preemptive action reflects strategic planning that prioritizes worst-case scenario protection over optimal financial outcomes. The confidence erosion in the US dollar as reserve currency represents a fundamental shift in global monetary relationships that extends beyond China to encompass multiple major economies. For decades, the dollar's reserve status provided the United States with extraordinary privileges, including the ability to finance government deficits through foreign treasury purchases while maintaining artificially low borrowing costs regardless of fiscal responsibility levels. China's treasury liquidation signals recognition that these arrangements have become unsustainable and potentially dangerous for foreign dollar holders. The use of financial sanctions against Russia, freeze of central bank reserves, and exclusion from SWIFT payment systems demonstrated how dollar dependence creates vulnerabilities that override traditional investment considerations. Countries holding substantial dollar reserves face constant risk that policy disagreements could trigger asset freezes regardless of legal protections. The sanctions precedent destroyed assumptions about neutral financial asset status that previously encouraged foreign treasury accumulation. When political relationships supersede contract law and property rights, traditional safe haven assets become political weapons rather than neutral stores of value. This recognition drives systematic movement away from dollar-denominated assets toward alternatives that provide genuine neutrality during geopolitical tensions. The direct impact on American families becomes apparent through interest rate transmission mechanisms that connect Chinese treasury sales to domestic borrowing costs. When major treasury holders liquidate positions simultaneously, it reduces demand for new treasury issuance while flooding markets with existing bonds seeking buyers. Basic supply and demand relationships force Treasury yields higher to attract sufficient buying interest to clear increased supply. Rising Treasury yields immediately affect all dollar-denominated interest rates because Treasury securities serve as benchmark pricing for mortgages, corporate bonds, credit cards, and consumer loans. A 1% increase in 10-year Treasury yields translates into approximately 1% increases in 30-year mortgage rates. For families with $400,000 mortgages, this represents additional monthly payments exceeding $200 while reducing home affordability and refinancing opportunities. Credit card interest rates respond even more dramatically because they incorporate risk premiums above Treasury benchmarks. As benchmark rates increase, credit card companies raise borrowing costs that affect millions of families carrying consumer debt. Auto loan rates increase similarly, making vehicle purchases more expensive while reducing consumer spending power across the broader economy. The Federal Reserve faces an impossible policy dilemma as foreign Treasury demand disappears while domestic financing needs continue growing. Government deficit spending requires continuous Treasury issuance, regardless of foreign appetite changes. When traditional buyers like China reduce purchases, alternative buyers must emerge or yields must rise sufficiently to attract adequate demand from remaining market participants. The Fed's options include allowing market forces to determine Treasury yields at potentially destabilizing levels or intervening as buyer of last resort through quantitative easing programs that purchase Treasuries with newly created money. Market-determined yields could reach levels that trigger banking system failures and economic recession. However, Fed intervention through money printing creates inflationary pressures that erode purchasing power while potentially accelerating foreign abandonment of dollar-denominated assets. This buyer of last resort scenario forces the Fed to choose between financial system stability and currency credibility. Extensive Treasury purchases by the Fed essentially monetize government deficits by creating money to finance spending rather than borrowing from legitimate savers. This process generates inflation while reducing incentives for fiscal responsibility because politicians face no meaningful borrowing constraints when central banks provide unlimited financing. The inflationary consequences affect all Americans through reduced purchasing power, while particularly harming fixed-income populations, including retirees, savers, and workers whose wages don't adjust rapidly to price increases. The regressive nature of inflation taxation falls disproportionately on lower-income families who spend larger portions of income on necessities rather than assets that might provide inflation protection. China's systematic shift toward gold and physical assets reflects strategic recognition that paper claims dependent on institutional credibility provide inadequate security during geopolitical competition periods. Chinese gold purchases have accelerated dramatically, while official reserves likely understate actual accumulation because purchases through Hong Kong and private channels don't appear in official statistics immediately. The transition from paper promises to physical wealth operates through multiple channels, including direct gold purchases, infrastructure investments, commodity stockpiling, and real estate acquisitions that provide tangible assets independent from financial system stability. Unlike treasury bonds that represent claims on future government revenues, physical assets maintain intrinsic value regardless of issuing authority, credibility, or political relationships. China's Belt and Road Initiative exemplifies this physical asset strategy by creating infrastructure investments that generate economic returns while establishing strategic influence across multiple regions. Ports, railways, communication networks, and energy facilities provide concrete strategic value that cannot be frozen or confiscated through financial sanctions. These investments create alternative economic relationships that reduce dependence on Western financial systems. Commodity stockpiling programs create strategic reserves of critical materials, including energy resources, industrial metals, and agricultural products that provide economic security during supply disruption periods. Physical commodity ownership eliminates counterparty risks, while ensuring access to essential materials regardless of trade relationship changes or sanctions regimes. The BRICS de-dollarization strategy encompasses multiple initiatives designed to create alternative financial architectures that operate independently from dollar-dominated systems. The BRICS payment system development, bilateral currency arrangements, and commodity-backed settlement mechanisms all contribute to systematic reduction of dollar dependency across participating economies. Digital payment infrastructure development enables international trade settlement without dollar conversion requirements while providing sanctions-resistant transaction capabilities. The mBridge project connecting central bank digital currencies from China, Thailand, UAE, and Hong Kong demonstrates technical feasibility for dollar-independent international payments. These systems process billions in annual trade volumes while establishing precedents for broader adoption. Bilateral currency swap agreements between BRICS members facilitate direct trade settlement using local currencies rather than dollar intermediation. China-Russia trade increasingly settles in yuan and rubles, while India-Iran transactions use rupees for energy purchases. These arrangements eliminate dollar dependency while reducing transaction costs and foreign exchange risks for participating countries. The new development bank and other BRICS financial institutions provide project financing using member currencies and gold rather than requiring dollar-denominated lending. This creates alternative development finance sources that reduce dependence on Western institutions like the World Bank and International Monetary Fund that operate through dollar-based systems. Regional trading arrangements, including the Regional Comprehensive Economic Partnership and Shanghai Cooperation Organization, create frameworks for reducing dollar usage across Asian economies, representing over half of global economic output. These agreements establish preferential trading terms that encourage local currency usage while reducing incentives for dollar-based transactions. U.S. banking system vulnerabilities emerge through duration mismatch problems, where banks hold long-term treasury bonds purchased when interest rates were substantially lower than current levels. As rates increase, existing bond portfolios show mark-to-market losses that reduce bank capital while potentially triggering regulatory intervention if losses exceed capital buffers. Regional and community banks face particular risks because they typically hold larger treasury and agency bond portfolios relative to their capital bases compared to major money center banks. The 2023 banking crisis demonstrated how rapidly deposit outflows can force bond liquidations at substantial losses when depositors lose confidence in institutional stability. The hidden nature of these losses creates systemic instability because accounting rules allow banks to classify bond holdings as held-to-maturity investments that don't require mark-to-market recognition unless forced sales occur. However, underlying economic losses exist regardless of accounting treatment, while creating vulnerabilities that become apparent during deposit stress or regulatory examinations. Commercial real estate exposure compounds banking sector risks, as rising interest rates reduce property values while increasing refinancing costs for leveraged property owners. Many regional banks concentrated commercial real estate lending in their local markets while facing simultaneous pressure from bond portfolio losses and potential loan defaults. The feedback loop between banking stress and treasury market stability creates additional complications, as bank failures could force additional treasury sales while reducing institutional demand for new issuance. Failed bank resolution often involves asset liquidation that could compound selling pressure in treasury markets exactly when stability becomes most important. Insurance companies and pension funds face similar duration risks through their bond portfolios while confronting liability increases as interest rate assumptions affect actuarial calculations. Life insurance companies with guaranteed return products face squeeze between higher liability costs and existing asset returns that may prove inadequate to meet obligations. The emergence of a new global financial order reflects fundamental shifts in economic power and strategic relationships that extend beyond immediate US-China tensions to encompass broader multipolar competition. The era of unchallenged US financial hegemony, enabled by universal dollar acceptance and treasury market dominance, appears to be ending as alternative systems achieve operational capability. Financial fragmentation creates multiple competing systems rather than single global architecture centered on dollar-based institutions. European efforts toward strategic autonomy, BRICS alternative development, and regional integration initiatives all contribute to systematic reduction of centralized US influence over global financial relationships. This fragmentation process increases transaction costs and reduces efficiency compared to integrated global systems, but provides participating countries with strategic autonomy that many governments value more highly than optimal economic efficiency. The willingness to accept higher costs for reduced dependency suggests permanent structural changes rather than temporary policy adjustments. Technology developments including central bank digital currencies, blockchain-based settlement systems, and artificial intelligence-enhanced trading platforms enable alternative financial architectures that weren't technically feasible during previous periods of geopolitical competition. These technological capabilities allow smaller economies to participate in sophisticated financial systems without depending on established Western institutions. The transition timeline remains uncertain because existing relationships and infrastructure cannot be replaced immediately, while new systems require years of development and testing before achieving full operational capability. However, the accelerating pace of change suggests major structural transformation within the current decade rather than gradual evolution over longer periods. Economic nationalism trends encourage countries to prioritize domestic financial stability and strategic autonomy over international integration and efficiency gains. This represents reversal of globalization trends that dominated the late 20th and early 21st centuries while creating conditions for increased international tensions and reduced cooperation. The wealth transfer implications affect different population groups differently, as dollar-denominated asset holders face potential losses, while owners of physical assets and alternative currencies may benefit from portfolio rebalancing toward non-dollar alternatives. American families holding primarily dollar-denominated assets, including bank deposits, treasury bonds, and domestic real estate, could experience reduced purchasing power if dollar depreciation accelerates. International investors and sovereign wealth funds may accelerate diversification away from dollar assets while increasing allocations to gold, commodities, and currencies from countries with more sustainable fiscal positions. This creates systematic selling pressure on dollar assets while supporting alternative asset classes and currencies. The policy response possibilities include attempts to strengthen dollar attractiveness through higher interest rates, fiscal consolidation to reduce treasury issuance requirements, or aggressive intervention to maintain existing financial relationships. However, each response option involves significant costs while potentially accelerating rather than slowing the transition away from dollar dominance. Capital controls or restrictions on foreign treasury liquidations could slow the pace of change while risking destruction of dollar credibility and acceleration of alternative system development. Such measures would signal recognition that dollar hegemony requires coercion rather than voluntary acceptance based on economic advantages. Military and diplomatic responses to financial competition could escalate geopolitical tensions while potentially accelerating rather than slowing financial decoupling as countries seek to reduce vulnerabilities to economic warfare. The interconnection between financial and military competition creates risks of broader conflict that could fundamentally alter global economic relationships. The historical precedent suggests that reserve currency transitions typically occur over decades rather than years while involving multiple competing systems before new equilibrium emerges. However, modern communication and financial technologies enable much more rapid changes than occurred during previous reserve currency transitions from sterling to dollar dominance. Understanding these structural changes provides context for recognizing that current developments represent fundamental shifts rather than cyclical variations in international financial relationships. The mathematical impossibility of continued deficit financing through foreign treasury purchases, combined with geopolitical competition and technological alternatives, creates conditions for systematic transformation regardless of specific policy responses or timing considerations. This analysis examines observable trends and their logical consequences rather than predicting exact outcomes or providing investment advice. Financial system transitions involve complex interactions that can evolve unpredictably while creating both opportunities and risks requiring careful evaluation. The end of US-China financial interdependence represents one component of broader global rebalancing that could affect all aspects of international economic relationships while creating fundamentally different operating environment for businesses, investors, and policymakers worldwide.